So this is a webinar all about interest rate updates, and we're going to focus on how lower rates can boost your buying power in Long Beach and LA County specifically, but really throughout Southern California. Today's webinar really is focused on home buyers. I am considering creating a specific webinar if you are thinking about selling. So talk about how these interest rates are going to affect the selling market. And then a separate webinar if you're a homeowner and you're trying to find out, is this the time to refinance? What can I be doing to make the most of the home I already have? But those will be separate webinars. So if that's something that you would be interested in seeing, drop a comment and let me know. Yes, please make that, and I'll make sure that you get a copy of that. But today's really is focused on or tailored for home buyers, whether it's your first home, a second home, you're upgrading, downsizing, investing. This is going to be the webinar for you. Okay. So if everybody is in fact in the correct webinar, let me go ahead and introduce myself. So for those of you that don't know me, my name is Melissa Urena. I am a realtor at Real Brokerage, and me personally, I live in Long Beach. So my area that I focus in is going to be Long Beach and LA County specifically, but I do also cover OC and IE. Essentially, I go where my clients' needs take me. I work with my darling husband, Juan Castro. Juan, if you want to say
I
hi
don't
to
know why it
everyone.
says Melissa on there too on mine, but
He's my alter ego, my right-hand man, my soulmate. So Melissa Orega number two. Juan and I are a husband and wife team. And together, we've had the pleasure of helping over 370 buyers and sellers throughout Southern California in the 14 years that I've been a full-time realtor. He is also the moderator for us here today. So he's going to be taking comments, questions in that chat. So that's available for you. And Juan and I are accompanied by a trusted partner, Eva. Eva, I'll let you introduce yourself to everyone.
Hello, everyone. My name is Eva Melgarejo. I work with New American Funding. I have been in the business for 10 years, and I've had the pleasure and honor of helping over 250 families reach the goal of homeownership. I actually have a master's in financial planning, and I am officially a CHFC, which just means that I can talk about finances 360 degrees, 365 days a year. I live in Long Beach and I serve California. Our company is licensed nationwide, so we can always support you with any needs across the nation.
Thank you, Eva. Eva is our licensed loan officer, and she's going to be the expert voice for all things interest rates once we get into the real nitty gritty here. Okay, so for anyone who logged in late, I just want to reiterate the purpose of this webinar is to show how the downward trend that we're seeing in interest rates is creating a lot of opportunities for home buyers in Southern California right now. We're going to start off the webinar with a clarification point about interest rates, because I'm hearing a lot of confusion about this one thing when I talk to clients. So we're going to square that away first to make sure everyone's on the same page. And then after that, we're going to move right into talking about where today's mortgage rates are and how that benefits you. From there, we're going to answer two of the most frequently asked questions that Juan, Eva, and myself are hearing over and over and over since all the news about interest rates started, going through the airways. So we'll answer those two really important repeating questions. Then we're going to wrap it up by giving you some actionable steps, specific things that you can actually be doing in this moment to take advantage of those decreasing rates, like I said. And at the end, we will have some time for Q&A. All righty, let's kick it off with that clarification on interest rates. Like I said, this is a point of confusion for some people that I'm talking about. So I want to make sure that we all know that mortgage rates and the federal funds rate are not the same thing. So I want to clarify this headline. A lot of us have been hearing and seeing the Fed just drop rates by, a quarter point. That does not mean that mortgage rates have dropped by a quarter point. Okay, those are two different things. And to make sure that we all fully understand that point, I am going to have Eva explain to us what is the difference. Eva, what is the difference between the federal fund rate and mortgage interest rates? Can you walk us through this?
Absolutely. So let's understand that the what exactly is the Fed rate impacting. So it's going to impact bank-to-bank lending. They're the ones that are imposing the rate of interest at which each bank can lend their excess of funds to another bank. So it's going to impact your personal loans, your credit cards, your HELOCs, and all of those are going to be set by the Fed. So when you're hearing 0.25% less, that's where it's impacting. Now, when we're talking about the mortgage rate, we're going to be looking at the home loans, but those are not set by the Fed, as Melissa mentioned. Those are influenced by market expectations, they're influenced by inflation, and also the decision of the Fed. So let's talk a little bit more about the Fed rate cut. It usually, when the Fed reduces the rate cut, it's going to put pressure on in our industry for mortgage rates to lower. But the actual effect depends on investor expectations about growth and inflation.
Okay, thank you for that. If anyone has questions about that, that's perfectly normal. Drop it in the comments, any clarification points needed, and we will certainly circle back to this. Okay, so now that we know that those are two different things, let's say that someone is gearing up for an action, whether it's purchasing the first home, purchasing an investment home, upgrading, downsizing, whatever it is, and they really want to have a pulse on what's happening on mortgage interest rates. What are some ways that they can stay informed and just understand what's happening?
So a good rule of thumb is to see where the 10-year is and add 2% to that. So think of 2 points, 2% above what the 10-year treasury yield is. And you can keep track of those on Bloomberg, WSJ, CNBC. That's where you want to follow the 10-year yield. And you can also sign up for my newsletter, as Melissa's newsletter.
Yes. So with this moment that we're entering with, rates really ticking and doing things, doing different things, I'm going to start adding a section to my newsletter where I'm going to track rates every month again. So if you're trying to figure out, with refinancing, purchase, whatever it is, you can sign up for my newsletter, and that's going to just keep you posted. My husband Juan will drop in the link into the comments there in the chat where you can go ahead and sign up. Now, Eva, before I move on to the next chart, I want to ask you about this because I've heard something in the news that when the Fed actually announced their interest rate, their cut, mortgage rates went up. Why? What happened there?
Yes, they did go up, and here's why. Because remember that our mortgage rates, we are going to always be ahead of what we're expecting the Fed to do. So if the Fed is expected to reduce the interest rates, we're going to start adjusting our interest rates as well. So our interest rates were a little bit lower than the announcement came, which was great, except that during that announcement, they were very cautious to say, we're not very sure about inflation. We are seeing some numbers that we're not too sure which direction we're heading. This could be momentarily, or this could be a long-term effect. So we're just going to remain cautious. That comment made us in the mortgage industry take a step back, right? Because our rates are also judged by the inflation of the country. So if the Fed is a little bit concerned, then we're going to be very concerned, and we're going to be very conservative. So we took a step back. Interest rates went up just a little bit.
More okay. Can you define just a little bit, just so where people aren't thinking like, oh my God, we're back at 25%, which we were never there, but go ahead.
No. And let's remember that the impact of the Fed is on short rate term loans. So again, your credit card statement, your HELOC, your car, your personal loans, all of those are affected by those rates. So when we're talking about the mortgage rate, yes, they did go up just slightly, but we're expecting rates to continue to decline the remainder of the year.
Okay, wonderful. Okay, so now that we've made that critical point so that we're all talking about the same thing, the headlines, the Fed's doing this, the Fed's doing that, that's over here. Mortgage interest rates are over here, and they're a separate thing. We've defined that. Wonderful. Good. Let's go ahead and jump right into it. We're going to talk about current mortgage interest rates this year, where we are this year, where we're going next year. And before we dive in, I'm curious to hear from you guys. What are you thinking about interest rates? What are some of your questions, concerns, and worries? Go ahead and drop those in the comments. Let us know even what you think interest rates are going to do at the end of this year, at the end of 2026. We'll give you the answer in the next slide, but I'd love to see your comment, your guesses anyway. Let's start with this one. Eva, can you walk us through this graph that kind of explains 2025 in rates for us?
Absolutely. So at the beginning of the year, we started around 7% on the interest rate. We have slowly been declining on the interest rate, and we are currently between 6.25 and 6.5. Now, let's remember that we are moving in the right direction, right? So even if we're looking at 7% at the beginning, we're already 0.5% lower than where we were in January.
Okay, so if I'm reading this graph correctly, we started early in the year, essentially at 7%, and I did see some folks quoted even above 7% in the beginning of the year. And every quarter since, we've kind of been gradually going down. And at this moment, we can safely say that we're at between 6.25 and 6.5. I want to clarify, guys, that we're talking about the 30-year fixed mortgage rate right now. 15-year other products are going to have different rates. Right now, we're talking about the 30-year fixed. Now, Eva, you mentioned earlier that the mortgage rate went up after the Fed announcement. Does this 6.25 between 6.25 and 6.5, is that where we still are, even given that we inched up a tad?
Yes, absolutely. Mhm.
Okay, wonderful. So then that's where we are, even given that announcement. If you guys dropped in your guesses about where we might be at the end of the year or 2026, this next slide is gonna let us know who was right. Let's go into, we know where we were this year, 2025, and where we are in this moment. Let's move into some prediction territory with the caveat that nobody has a crystal ball. But Eva, can you walk us through this chart and then tell us what you think?
Absolutely. So different entities are going to make different predictions. In this graph, we're going to see Fannie Mae, Wells Fargo, and MBA. So if you follow the lines, you can see that Fannie Mae is a little bit more aggressive in how they're predicting interest rates, bringing
So
us
Fannie
down.
Mae is this blue line right here, right?
Correct. That blue line. And that's, I'm pointing on my side. Yes, Melissa, that blue line. So we can see that quarter four, we're expecting to be between 6.5, 6.4, but Q1, we're expecting to continue to decrease all the way to 6.1 in last quarter of 2026. So a year from now, we should be in the very, very low sixes. However, you can see how Wells Fargo remains a little more conservative, and they're staying at 6.5. So some, they keep us around 6.5, others in the low sixes towards the end of 2026.
Okay.
Now, I personally think we are going to be in the very low sixes, if not the very high fives, by the end of 2026. What do you think?
Yes, I am starting to hear some chatter about that number 5. So this data point, I think, is incredibly conservative. So would you feel safe saying that Wells Fargo and MBA are giving us absolute worst scenario, with the reality probably being even a tad lower than what Fannie Mae is saying here? Because I'm starting to hear 5s as well.
I am going to say that your prediction is correct. Yes, we should be in the very low sixes, high fives.
Is there any evidence? Is there any reason for us to think that we are going to see some 3s, some 4s, some low 5s, anything like that in the next year?
We're going to see him in our dreams. But definitely not in reality, guys. I'm so sorry, Nestor. I know. No, we're not going to see them. So we have to understand, and I don't want to derail to another conversation, but we have to understand, why is it that we had a 3% interest rate, even 2.5 interest rate, right? We had a pandemic that hit the world, not just us, and it seriously stopped the economy. So interest rates were lowered to activate the consumer. Now, are we going to see another pandemic? Hopefully, never in our lifetime, right? So I don't believe, yes, based on history, we see them once every 100 years. So unless we're planning to be 104 45 for me, I won't see another one. So there goes the 3% interest rate.
So some high fives is the best case scenario.
Mid
The
fives is
investor does have a
historic.
question in the chat.
Babe, is it okay if we save it, unless it's super printed, maybe save it to the end, because I want to get folks like back
That's
to
fine.
dinner. Unless, is it something confusing that we can clarify or
No,
just?
we can address these questions towards the end. That's fine.
Okay. Okay. Thank you, Eva, for that. Guys, I just want to make sure that I'm getting you back to your families in a timely manner. Okay, so now that we know that today's mortgage rates are in the mid to low sixes, with the possibility of 2026 taking us to the high fives potentially, let's talk about how this current moment right now, 6.25% and 6.5% are actually a benefit to the home buyer. So there are three major benefits to the home buyer at this moment. And I repeat, this is whether it's your first home, your second home, upgrade, downsize, whatever it may be, all of this applies. Number one, you do have increased purchasing power. You're going to have lower monthly payments, and you're going to have more homes to choose from. As a general market behavior, when rates drop, more people can afford homes, therefore more people enter the market, therefore there is more buyer activity, therefore more people list their homes, and as home buyers you have more options to choose from. So these are the three major benefits that are coming to you at this moment where we are today. Now, we're going to look at this chart because it may seem like the mortgage rates decreases that we're talking about right now may not seem significant. I understand that saying, hey, we were at 7% at the beginning of 2025, and now we're at 6.25%. That might not have as much of a wow factor than if I were to tell you we were at 7 and now we're at 4 and now we're at 3. But as Eva said, there's just no evidence that we're ever going to go back to those moments. And so the good news is, the walk away good news from that is that even a half a point difference means hundreds of dollars of savings for you. So Eva, can you please walk us through what all these numbers in this chart mean, please?
Of course. So we're going to take a look at $650,000 purchase price or price of the home. If we're looking at a 7% interest rate with a 20% down payment, your principal and interest is going to be $36.72. So what does that mean if now at a 6.5, how much money are you actually saving? So your principal and interest is going to be $32.87, so $3,287. Your monthly savings are going to be $385 now per year. $4,620, and over the period of 30 years, you're going to be saving $138,600. Now, if we look at a 6%, which is what we're expecting end of next year, now your savings, your principal and interest is going to be 3,118. Your monthly savings are 554 per year. You're going to be saving 6,648, and over the period of 30 years, 79,776. I think that when we look at the amount of money that you're going to be saving just for half of a point, what could you be doing with 4,620 extra a year, right? You could be reinvesting that into the principal of the home and paying it off earlier. You can buy life insurance. There are so many things that you can be doing with that money, even though the change on the interest rate seems to be very slow.
And then to emphasize, so we're saying for the purposes of the slide, we just went from 6.5 to 6. But because we are, some folks are being quoted at 6.25, potentially even lower with some tools that we'll talk about in the next slides, your savings can actually be somewhere between these two numbers, not necessarily here.
Correct.
Okay, wonderful. So I did also want to give an example of an $850,000 purchase, because once we start looking at these higher price points, you'll see how significant even a half a point decrease is. Eva, can you walk us just through this one if somebody were to purchase 850?
Absolutely. So 850,000, a 6.5 interest rate. Your principal and interest payment is 4298, 4,298. Your savings compared to a 7% are 503 a month. Per year, 6,036. Over 30 years, 181,080. So those are pretty significant savings. If you are at a 6% interest rate, now you're saving $724 per month. And then per year, 8,688. Over 30 years, 260,640. You could have bought a cabin in Big Bear with those savings.
And again, at today's moment, you'd be somewhere between these numbers with a 30-year fixed. There are tools to lower that even more, and we'll talk about them in the next slide. But the reason I wanted to give you a 650 example and an 850 example is to show how the higher the price point you're shopping in, the more that half a point difference it's going to make, even if it doesn't sound, so wow when you just say half a point. And then the lower price point that you're shopping in, if you're shopping very entry level, maybe a starter condo, 400 something, 500 something, the savings are there, but perhaps it's not, being rate sensitive. It's just a lot more important when the price is higher. Alrighty. So let's go ahead and move on to some of these frequently asked questions. We're about halfway through here, guys. I wanted to move here quickly so we can get some answers. But at this point, we're going to go ahead and answer two of the most common questions that we're hearing over and over and over. Can you guess what those questions are? Drop your guess in the comments and let me know if you are asking these questions too, because we're hearing them quite a lot. Ready? Let's go. Should I wait for interest rates to drop even more? I'm hearing this question on the daily. And before we move on to answer this question, I want to emphasize that buying a home is such a large purchase, such a life-consuming decision that interest rate alone should not be how you're making your decision about buying a home. You should really be having a full, thorough picture that includes your overall life and financial goals, not just interest rates when you're making a decision about, is it time for me to buy a home or should I wait? Now, because I'm hearing this question so much, I actually went onto my Instagram and I threw up a poll to see what folks had to say. And the question that I posed to the audience was, would you rather? Number one, buy now at lower prices, or at current prices, I should say. I don't want to be misleading and say, Laura, that home prices are dropping. No, lower prices relative to the fact that they're going to be higher in the future. So would you rather buy now at current prices with higher rates, or do you want to wait for prices to go up, but your rates are going to drop? And my audience was split 50-50. You guys can see the poll. 50% of my audience said, let's go, let's get it done. And 50% of my audience said, I think I'll wait. By the way, if we're not connected socially, this is my Instagram handle. I'd love to connect with you guys there. My husband will drop my account in the comments. So if we're not connected socially, please make sure to follow. Okay, I'm going to answer the poll question myself. If it were the right time for me personally, in my season of life, in my marriage, in my job, in everything, I would not wait for interest rates to drop further. And here is why. Okay. There's two reasons why I wouldn't wait. Reason number one is because when interest rates drop, that means more competition from buyers. And when there's more competition from buyers, that's going to drive prices up. So that's why I wouldn't wait. This chart tells that story. Eva, can you walk us through the chart so that everybody can understand why I'm saying that?
Absolutely. So let's look at when the rates at the beginning of the year, they were at 7%. You can see that we were in the limited area, right? Buyer demand was in the limited area. But as rates continue to drop, now we're currently in the good area, 6.5. So lower rates are going to mean higher demand. What does that mean? You're going to have more competition when you're trying to purchase that property. So right now that we're in this good area, as we're approaching the 6% hopefully next year, then we're going to be in the strong demand. Now, this is the area that is going to create bidding wars and it's going to drive prices up.
Mm-hmm. Mm-hmm. Okay, so I gave my answer. Your personal, and this is not advice for anyone. I'm just curious about your personal take, how you make your financial decisions as a financially, someone with a master's in finance. Would you buy up here in the weak, in here in the limited, good or strong? What would be your?
I would buy in the limited category or the weak category. Why? Because it's going to be less competition for me. So that means that that fixed price that I am paying for that property ideally is going to be lower. Right? Because I'm going to have less competition. So I can negotiate more. I can probably get a price reduction. Maybe I'm shooting for seller's credit because there's not a lot of people putting in offers on those properties. Now, I would not advise for people to wait for the interest rate to drop in order to get into the market. You want to get into the market and then you can always refinance. That's a better strategy because keep in mind, if you're waiting for that interest rate to drop and you're going to buy when you have more competition, that purchase price is going to go up. So now you're paying more money for that same property.
Okay, so the key here sounds like as long as we're staying somewhere in this good category, which is when interest rates are somewhere between 6.5 and 6%, seems like this might be a sweet spot. Going into strong, home prices are going to go up. And you can, if your prices go, home prices go up, that's it. That's the price you bought the home. You can't change your rate. But if you buy up here where home prices are here, then you caught it at a lower home price before it shot up, but you can lower your interest rate down the line. Which takes me into reason number 2, why if it were up to me, I would also not wait and go ahead and buy now, because we do have tools that can help you lower your monthly rate. It is a misconception that you have to wait for interest rates to drop further in order for you to get as low of a monthly payment as possible. There's 3 main tools that we're going to explore today that will help you have the benefits of a lower rate in the future, but have it now. And that would be ARM loans, number 1, buy downs, number 2, and points, number 3. So let's go ahead and take a look at each of those individually. Go ahead and walk us through how ARM loans work or what this is.
Of course. So an ARM loan is an adjustable rate mortgage. Exactly what it sounds like. It means that your rate is going to adjust. Now, it depends on the terms. You're going to see ARM loans with a 5-1, meaning your entry rate is going to stay fixed for those 5 years, and then it changes once after that. In this example, we're looking at a 7-1, meaning your entry level rate, which is usually lower than that of a 30-year conventional loan, is going to remain fixed for the first 7 years. Then you're going to see a change on year 8. So that's what we call an ARM loan, adjustable rate mortgage. Now, this could be a great strategy for those that are thinking of maybe buying your first home and staying there for the first 5 years. So if you know that you're going to be changing homes, then the fact that your rate is going to change in 7 years, it's actually saving you money right now, right? In the short term. That's your entry level rate.
And how much lower will that entry level rate be compared to, for example, the 6.25 that if you were to get a 30-year fixed?
We are seeing great pricing in these loans, anywhere between half of a point to almost a point lower. So
Lower.
let's just say, yeah, so let's just say that you have a 6.5% coming in, but if you utilize an ARM loan, you may be able to have a 6% for the first 7 years of that loan. So it's always good to analyze the numbers, make sure that this is the right strategy for you, but this is just allowing you to have more cash in your pocket.
Got it. Okay, so they can be anywhere between half a point to a full point lower than a traditional 30-year fixed.
Correct.
Okay, wonderful. All right, tool number 2 at our disposal that we can use to make sure we're bringing down our monthly liability, temporary buy downs. How do these work?
So think of you prepaying for that interest. So you're going to pay points, and we'll talk about points right now, to be able to buy a temporary rate. Let's look at a 2-1 buy down. That's the example that we have on the screen. So a 2-1 buy down means the first year, your rate, let's assume that your rate was going to be a 6.5% right now, it's going to be 2 points lower. So your first year, you're going to pay 2 points lower than what you should have paid, which is instead of 6.5, you would have paid 4.5. And then the second year, it's going to be 1 point lower than what you should have paid. Instead of 6.5, it's going to be 5.5. So you're temporarily reducing the interest rate in a 2-1 buy down, 2 points the first year, 1 point less the second year.
Okay, so this would probably be a good option for someone that maybe is expecting to have a raise in their job or it's for upwardly mobile, something like that. And they just need those first 2 years to maybe to get on their feet or get comfortable, something like that.
Absolutely. Again, it allows for immediate savings for the first 2 years.
And you said that it can be as low as a 4.5.
Yes, because if you're purchasing a 2-1 buy down and your rate right now is 6.5, so 2 points less the first year, your rate is going to be 4.5.
Oh, wonderful. So we will see fours, Eva.
Yes, yes.
Yeah, it doesn't apply to that, but yeah. And the wonderful thing is you can actually use seller credit. So what this means, guys, is that if you're going to negotiate to buy a home, rather than saying, oh, I'm going to offer the seller $10,000 less or $15,000 less for that home, ask them to give you that in credits, and then you can just turn around and give them to your lender, and then your lender will be able to get you that 4.5 for the first year, 5.5 for the second year. So that is a way to get more savings than if you were just to get the home for a little bit less. So, and all of these are very much on a case by case basis. We're talking in generalities. If you want this calculated for your situation, for a home price that you have in mind, Eva has graciously agreed to open up her calendar to do free consultations where she can run these numbers for you at absolutely no cost, no obligation, just information so that you can see how an Excel sheet would look like for you, for example. Okay, and the third tool that we have at our disposal is what we're calling points or permanent buy downs. How do these work?
So 1 point is the equivalent to 1% of your loan. That's really, really important to understand. That doesn't mean that your rate is going to drop 1%. It just means 1 point, the equivalent to 1% of your loan. What you can use points, or you would pay points also for a permanent buy down. Now, the permanent buy down, instead of having the initial or the introductory rate, as we talked about with the 7-1 arm, or lowering your rate 2 points the first year, 1 point the second year, permanent buy down is permanently for the 30 years of that loan. Okay, so
Got it.
that's where you use the points to buy permanently the rate for the 30 years of the loan. Now, you're obviously buying permanently so that you can reduce the interest rate and you don't have to be concerned with when is the rate changing.
Gotcha. Okay, so the difference here is that the change is forever. You don't have to worry about it changing.
Correct.
Okay, great. And then I know this is different for everyone. Roughly speaking, if someone were paying a point, how much would that lower their interest rate by?
I would say expect it to lower it by maybe half of a point.
Okay.
I
Okay,
think
wonderful.
that's a really good rule of thumb. If you're going to pay 1 point, expect your rate to be reduced by half of a point.
Okay, great. Thank you for that. All right, guys. So now we're moving to the second question that we hear the most. I don't know if any of you guys guessed this and the questions that I'm hearing a lot, but the second one, Eva, Juan, and I are hearing is, should I wait for home prices to drop? All right, let's get into it. So here's the thing. Home values almost always go up in the long run. Okay. So what this chart is telling us, it's showing us on this side here, it's showing us the percent of increase that home prices have been increasing year over year. And this bottom one is showing us the year. And it's starting to track from 1992. So we have a 33-year view over 3 decade span of how home prices have behaved. And you can see that on average, home prices have increased in the last 3 decades about 4.56 year over year. That means that every year that home you bought is going to be worth 4.5 more, 4.5 more, right? The dips here in these bars does not mean that the home prices went down. It means that they went up at this rate versus this rate. In fact, you can see that the only moment in time where we have negative bars, which is this rust color bar here, was during the 2008 financial crisis. That is the only time in the past 3 decades that we saw any significant decrease in home prices. So again, historically, overall, prices tend to just be, increase, not decrease. In fact, home prices are so resilient that even through recessionary periods, they're going up. Eva, what does this chart mean?
So this chart is going to show you how home values behaved in the last 6 recessions. Take a look at, we're looking at 1980. We've had 6 recessions since. You can see that only in 2 of those recessions, we actually saw the prices of the homes dropped a little bit. The decrease was minimal in 1991. And of course, the decrease was a little more significant, or a lot more significant, in 2008, and this was due to the financial crisis. I think it is really important to cover why is it that we had a financial crisis, but more importantly, why is it that we're not going to see that happening again? So sitting on the sideline waiting for prices to drop, even when some may be talking about a recession, is not a good strategy. We can see that in 2008, this happened because there were really no guardrails in place. If you remember, anyone with a pulse could get a loan. That is not the case now. We have a lot of guardrails in place. We're verifying information. We are doing a very good job at responsible lending. So we're not going to see this happen again.
So for me, these 2 charts tell a story that say you can buy now at current prices or buy later at higher prices. But the likelihood that there's going to be a moment in the foreseeable future that prices will drop, it's just not there. The choice is get the price the way it is now before it goes higher, or wait for it to go higher. Now, how much higher are we talking about? Well, let's look at this example. We saw in the previous chart that homes in the US tend to appreciate at an average of about 4.5% year over year. I want to emphasize that that is a national data point. California, SoCal, LA County, Orange County, these really expensive markets tend to appreciate at even higher rates, but I'm going to stick to 4.5 to be very conservative here. And let's look at what would happen for a $650,000 home. We're going to look at what happens to that value given the appreciation that that chart told us is average at year 5, year 10, year 15, and year 20. And these 2 numbers is the difference between what you will pay if you wait and the equity that you can have to your name, the wealth building possibility if you buy now. What I mean by that is if you buy a home at $650,000 if you would have waited 5 years, you'd be paying $810 for that very same home. But if you locked it down at $650 today, in 5 years, you'd have an additional $160,000 worth of equity to your name, wealth building. If you wait to buy in 10 years, you'd be paying over $1 million for that same home, or you could have $359,000 of equity built to your name. If you wait 15 years, that same home would be over $1,250,000, or you could have over $500,000, over $600,000 to your name in equity. So this is the real cost of waiting. At a $650,000 purchase, let's take a look of what that looks like at $850,000. Can you walk us through this one, Eva?
Of course. So if you buy a property now at $850,000, you would have had in 5 years $209,255 in equity. Or if you wait and you buy in 5 years, that same property would be $1,059,255. If you keep that property for 10 years because you bought it today at 850, then you would have in equity savings of $470,000 with $24. Or if you wait 10 years to buy, you would buy that same house for $1,320,024. In 15 years, you would have had in your equity 794,990, or you can expect for that home that is now costing 850,000 to be $1,644,990. In 20 years, you would have saved 1,199,957. So you would have been swimming in equity as opposed to paying 2,049,957. These numbers to me are staggering, especially when we look at 20 years, because for a lot of us, 20 years means retirement. So how long do we have to work to save $1 million to retire? And this is the
Yeah.
beauty of real estate.
The numbers are staggering too. I triple, quadruple checked my math on this because I was like, can this be real? It is real. This is a real cost of waiting. That's why they say, don't wait to buy real estate and wait. I want to put the caveat that as long as the financial moment makes sense for you. Don't want anyone to walk away, to stretch themselves thin or buy at a moment where you're not emotionally and financially ready. But if you are, this is the rule of thumb. If rates drop, as Eva mentioned earlier, if rates drop further, hey, you locked your home price before it got higher, and then you can refinance into a lower rate. If rates increase or they don't change anymore, then you will just be glad that you locked at this moment. Have you heard the saying before? Yep. All right. We're getting here to the home stretch, guys. We're going to go ahead and give you a recap of what we learned today and give you some actionable steps to walk away with today, and then we'll take some Q&A. So let's go ahead and do our recap. Eva, what did we learn about mortgages? Can you walk us through this recap?
Absolutely. So the federal fund rate and mortgage rates are not the same thing, two completely separate rates. Today's mortgage rates are hovering around 6.25 to 6.5% for the 30-year fixed. Experts are predicting for rates to remain around the same this year, with potentially decreasing into the very low sixes end of next year. ARM loans, buy downs, points are some ways you can further decrease interest rates right now.
Great. And then on the real estate side, what we learned was that waiting until rates drop, approach 6% means that you're also waiting for home prices to increase with those graphs we just saw. Home prices are increasing at an average of about 4.5. So those are those staggering numbers that we just talked about. This breaks my heart because believe me, I would want to run around buying homes too, but there's just no evidence at all of significant home price drops coming. Waiting to buy means you'll pay more. Buying and waiting, however, means that the increased home value will be equity in your name, money that you can liquidate and put in your pocket. All right, let's go ahead and talk about some actionable steps. What can you be doing today to prepare for a home purchase tomorrow? Whether tomorrow is the end of this year, next year, or sometime in the future. Let's say that you're someone thinking about buying a home and you want to have that home this year by December. What should they be doing? What are the 5 steps they should be doing, Eva?
You want to hire your realtor ASAP. You definitely want to get pre-approved about a month before you're going to go and look at properties, just to make sure that we have all your numbers and all your documentation in order for you to submit offers. Then you're going to go with your realtor that you've already hired and tour homes before submitting offers. That's going to take about 1.5 to 2 months before your target date. Then you open escrow, and that's about a month process. So if you're thinking of starting now, that means that you're going to be getting keys to your home in December.
All right, so these are some of the steps you should be taking if by the end of the year is your goal. Now, let's say that it's next year or sometime in the future. Here are 4 things that you can be doing today to prepare. Number 1, critically important, find out where you stand financially. The only way to do that is by talking to a loan officer, a lender such as Eva, or anyone that you trust so that you can understand what is my cost to own a home? What is my interest rate that I'm going to get? Of the tools that you shared with me, ARM, buy down points, which one of those is best for my scenario so I can bring down my mortgage as low as possible? You want to have all that information ready because now you have a strategy or a plan. And then from there, it's just a matter of preparing so that you can maximize that plan. Improve your credit. A 640 is fine for first-time home buyers. You can get a home loan with that, but if you want to aim for 740 and above, so you can get the most beautiful rates out there. You want to save for a down payment too. Rule of thumb, you want to have about 5 to 7% of the purchase price to cover your down payment and your closing costs. 5 to 7% does not mean your down payment. You can do a down payment as little as 3, but you want to have some money for your closing costs, your inspection, some other things. So I always suggest about 5 to 7 of your purchase price. If you want to know, have someone calculate the number value for you. Again, Eva's going to make herself available to run those calculations. And then I always suggest this to my first-time home buyers or anyone who's thinking about upgrading to their next home. Anytime we upgrade, our mortgage is going to go up. That's just even if it's a tiny bit. So I want you to practice your mortgage. And what do I mean by practicing your mortgage? You're going to be paying your would-be mortgage into an account. Let me have Eva run us through this example here. So there's a step 1 and 2 that you need to be taking to practice your mortgage. Eva, do you want to walk us through this?
Absolutely. So step 1, you want to determine what your monthly mortgage is going to be. Let's just use $5,000 as an example. Then you want to calculate the difference between that mortgage and your current housing cost. What that means your rent. So your current rent, let's assume that is $3,000. So $5,000, which is potentially what your new mortgage would be, minus $3,000, which is your rent, you have an extra $2,000. Right? Now, those $2,000, that difference, you want to put that money to work. You can put it into a high yield savings account, make some extra money, but this is going to allow you to practice feeling that payment of $5,000 month after month.
Correct. Same thing if you're looking to upgrade. If your current mortgage is 5,000, but the next home you want to, better neighborhood, better school system, bigger, gives you a bigger mortgage. You want to start same thing, just practicing that so that you're making a decision based on already having spent that money, so you know for yourself, does that work for me or am I going to be too crunched? Okay, so this is going to take us to a wrap up. We're all done, guys.